Thank you so much for tuning in. I'm actually joining you guys from Washington, D.C. I couldn't miss this one. So thank you so much for joining. And like my fellow hosts shared, I studied at the University of British Columbia, and I like talking about personal finance, investing, and also career guidance. Why? Because I realized that, when I talk to a lot of my friends, it seems easy, and it is easy. It seems simple, but it is not easy. So that's why I like to talk to, like people about personal finance and investing. But I do want to disclaimer that, the purpose of this presentation is just to share insight. It's not to be taken as investment advice. But the good thing about this opportunity is that if you are not comfortable and you feel that you are not comfortable to venture into the market now, it means, I recommend that you see a financial advisor, or maybe you can reach out to me so that I can educate you more on that, so that at least you become more comfortable. Over the years, I've realized that one easy way to lose money is to start investing before you are educated. So when you understand what you're investing your money in, whether cryptocurrencies, mutual funds, stocks, and bonds, you drastically reduce, the risk. That's one way that I reduce the risk before I even start investing. So I highly recommend that you do that. Now, I'm going to share with you the importance of investing because I think it is the foundation or the thesis upon which I base my investing. Number one, investing is important because it's a way to build wealth, right? Because you find that there's a thing called inflation, which is the increase in prices over time at a given time. So what usually happens is if you invest, in stocks, for example, and you know well which stocks to invest in, you can get on average maybe 10% or even more, right? And you can then beat inflation in the sense that inflation in Canada, in the US, is usually the target is 2%, but right now it's slightly about 3.5 or 3%. So that means if you're investing money, you're getting 10% per year, right? And inflation is 3%, you are getting 7% as real return, which means your wealth is actually growing. Unlike if you just save, in most cases, people get less than inflation rate. So that is the other important of, investing in stocks. And by doing so through compound interest, you can also grow your wealth. A lot of people think of Warren Buffett. A lot of people, they also don't mention that he became wealth, I think, when he was in his 50s. So he started investing around when he was 11 years or so, right? But he consistently did that. So if you understand investing and you do that, you are generating consistent returns, you can be wealthy, but it usually takes time unless you are speculating and you are lucky. But speculation comes with a lot of risk. So when I'm investing, the other aspect is that I want to have passive income. A lot of people want to retire in the sense that they don't want to actively work. So when you're investing, you can possibly get dividends. Or if your investments go up, whether in real estate or stocks, you can sell and get, some income from that through capital appreciation. But another key thing when you're investing, at least what I consider is, it's very important to have a diversified portfolio. That means you can invest in stocks, you can invest in real estate, some do crypto, some have cash, some go commodities like gold, as we will discuss in a bit. But having said all this, it's very, very important to manage risk. And I highlighted that one way to actually manage risk is to educate yourself, number one. Number two, invest in strictly things that you understand, right? And also understand, inflation, and also have a diversified portfolio that can be, I would say, an all-weather portfolio, because the market does not always go up all the time, right? Some years it can drop significantly. For example, we all know what happened when the COVID pandemic happened. It dropped in March 2020, but even though it finished the year, I think 24% up. So what that means is, let's say you are retired and the market drops by 50% and you have a portfolio that is only in equities, you have no bonds or you have no cash or any other thing to hedge, then it means if you liquidated that time, you would be selling at a huge loss, assuming that it would be down. So like I indicated before, I will go in a little bit more detail about the types of investment to consider in the stock market, how to invest in the stock market, the risk versus reward, and talk about some strategies that I use, not as investment advice, but just to share. It may work for me, but it may not work for you. But I think it's one way to also consider learning, but also share the importance of diversification and long-term planning, and then I'll share some details for us to connect if you like to connect. Now, as my predecessor mentioned, there are various ways of investing in the stock market. And on the right, you can see this is the S&P 500 returns from about 1920 to 2024. Basically, the S&P 500 is a basket of top 500 companies that are publicly listed in the US. So you are looking at the Apples of the world, Microsoft. So if you have one share, it means, let's say if Apple is 7%, you have 7 cents that is invested in that one share. So that is just the return. So it goes to show that if you're investing in the stock market, you should have a stomach in the game, because it doesn't always go up all the time. You can see that, in the financial, it was called, I think, the Great Recession in the 1930, 31 or somewhere there, you see this huge drop here, right? It dropped by about 47%. So it means if you were in the market, you had 100,000, it was, if you didn't liquidate, it would have dropped to 47%. And this is all, familiar, even if you look at people like Peter Lynch, when they ran the Magellan Fund, he was a famous investor in the US. It didn't go up in a straight line. But usually, if you know what you are doing, when the market drops and you understand the stocks that you invest, that's the best time to actually invest when there's fear in the market. Why? Because a lot of stocks would be discounted. Generally, it has been shown in research that people are not irrational, are not rational. They sometimes they just follow, they just panic without understanding the fundamentals. So when I put this graph for you to just demonstrate that it's very important when you're investing in stocks to understand that it does not go in a straight line. So you should, for me, what I then do is I always want to have an emergency fund. I'm a little bit extreme about it. I want to have 1 or 2 years worth of emergency fund. That is the basic living expenses. Then if the market drops, I then would have done research on the stocks that I'm interested in. So what I then do is I basically start off by the things that I use every day. What are the things that what company do I go to when I want to, that is publicly listed? If I want to buy books online, I think of Amazon. I'm using a MacBook, Apple, right? So how do I own Apple? So for me, I like to buy Berkshire Hathaway Class A because they have a big portion in Apple, and it's also a conglomerate in that they have different sectors, and it's managed by a very well-known legendary investor, Warren Buffett. Some people go and buy it directly through the exchange, and you need to have a brokerage account. So things to pay attention to is you should make sure that you understand, the fees that you are being charged when you are transacting. Now, as I mentioned, there are stocks, bonds have been described, but the beauty about bonds is that over the past couple of years, it's called, the portfolio theory. It has been shown that bonds, equities, and stocks, usually they go in opposite direction. So you see, when the market drops, a lot of people, they flee to bonds because they have a fixed, in some cases, they have a fixed interest, right? If, let's say it's 5%, you know that the principal is guaranteed. But who issue, the bonds? You have the government, let's say government of Canada, provincial government, or in the US Treasury. So they actually beg you to say, if you buy the bond for 100,000, maybe at maturity you get 3-4%, right? Then you get your principal plus interest, but it's kind of like guaranteed, right? But there are also some junk bonds, that is, debt that is from other risk, stocks. So at the end of the day, for me, the way that I invest, I like to have at least 20% in cash. And in terms of, where there is the hedge for the bonds, I like to buy exchange traded funds that track the volatility index, because usually when the market, something unexpected happens, there will be a lot of volatility. So there's what is known as the VIX. So that volatility, as people are panicking, it usually goes up in opposite direction of the equities market. So they are exchange traded funds. That is, index funds. Basically, it's a basket of companies. But what fund managers do is then they buy, securities that mimic, let's say, the top 500 companies. They are different. Like SPY, for example, is the top 500 companies. So they just have the ticker name, right? So it is the same. It mirrors the same equities or securities in that case that will be in the index, but you can't directly buy the index, right? But when I trade options, at times you can trade, SPX, that is the index, but you can't directly, at least from my knowledge, I can't directly buy that. If I want to buy the Dow Jones index, I can do so through what is known as an exchange traded fund that is managed by, a fund manager. Now, my colleague is going to talk about mutual funds, but some people also invest in commodities such as gold, agricultural commodities as well. These are usually through the futures trading. Basically, the idea is that you are hedging to say, if, prices go up or down, right? So if you short the market, basically you are betting that it's going to go down, right? And you get paid for that. And then if you believe you are bullish, if you believe that it's going, let's say it's in agricultural commodity like corn, you believe that maybe there might be shortage, then you can go long. So if then it goes up to that, beyond that level, you can get, profit from that. So that's what some people do. And then, like I mentioned, fixed income, you can just, buy some fixed income. That is, you are guaranteed your principal, for example, guaranteed investment certificates. And then you get interest on that. Now, like I mentioned, historically, I like to, when I design my portfolio, I like to manage my risk. So, but I like to think very long term. Like I said, I like to have an emergency fund. Some people may have debt. So there are different ways to go about it. Some people, they pay off the one with the highest interest rate. It's just what you're comfortable with. Why? Because when you have interest, you're basically paying something to someone. So investing, the idea is you get paid for investing. So in my case, I like to then invest in the stock market, particularly the US and Canadian stock exchanges, because I understand them very well. I live in Canada, and I read a lot of news reports and what's going on in the US. So that's why I do that. But historically, from 1923, statistics show that even though it goes up and down, the market, the S&P 500, only 95% of the investors, they are able to beat it. So usually it returns about 10%, right? You net inflation 3%, you get 7% return, right? But if you include dividends, it could be 12%. But the idea is that, it is well diversified. So I do that. Most of my investing, I put maybe 40-50% in the S&P 500, and securities such as Berkshire Hathaway that are diversified. Then I have very few individual stocks that I know. And those individual stocks that I understand, the Apples, the Microsoft, I only get in when there's a huge drop in the market, right? So that means I will have a margin of safety. In other words, if it drops by 40-50%, everyone is screaming, and I will have understood that the story has not fundamentally changed. People just freak out. It happened when Meta dropped, when they were trying to go the metaverse route. It had nothing to do with their profit margin. It has happened with Tesla. It has happened with Salesforce. So if you are following what's going on in the market, those are lifetime opportunities to drop. A lot of people actually, they got into Tesla when it dropped to 142 or $43 per share this year. Right now it's 220 the last time that I checked, but it went up to about 260. So equities market, usually it fluctuates. So that's very, very important. Now, like I've explained, it is important to buy things that you understand, but in summary, it is important to also balance the risk and the reward, right? And, like I said, you can invest in different forms: stock market, individual stocks, exchange traded funds. Some go, with mutual funds, but they do charge fees. Usually in Canada, my understanding is that it's 2%. My colleague is going to talk more about that. And bonds, like I said, usually they go in opposite with equities. So if you are at a retirement age, right, and there's a hit, there's something that happens, a drop of 50%, then that's when bonds can come handy, right? And you'll find that sometimes even companies may possibly cut dividends, because sometimes it doesn't make sense to pay out when, there's something that is going on in the market negatively. Then some people, they do real estate, right? And there are various ways of investing in real estate. You can buy a house. You can also invest in the S&P 500 or indices that have exposure to real estate. You can also invest in what are called REITs, real estate investment trusts. And then some people, they buy gold, as in like gold, you can buy it online through a broker, but also you can also invest in what are called exchange traded funds. There's GLD as an example. So now, just to give you perspective, historically, there was this professor at New York University, and he did research, but I just summarized this. What he did is he looked at the performance of the S&P 500 versus bonds, real estate, and gold, all the way from 1920, from 1923, but I just took this to summarize. So you can see, like I indicated before, that in some years you can see the market, it drops, right? But you see that it's across the board, right? But you see that sometimes gold, you can see that in 2002, when the market it dropped by 24%, gold, it went up by 23%. So you can see the pattern there. And overall, this is adjusted for inflation. In other words, they subtracted the average inflation. So this is real data. You see that the S&P 500 on average for these few years that I took from 2001 to 2022, it returned 6% real return that is adjusted for inflation, right? But overall, bonds, it was like, 1%. Real estate, it was like 2.3%. Gold, it actually retained, somewhat, higher than, all this. So it means at the end of the day, like you can balance your portfolio by having a little bit of, some of this depending on your comfort or your age, and also your risk tolerance. So you can check that out on that under that link. You can ask me to share with you that. Okay. Now, going to the last slide, you can have, like buy and hold, like I explained, right? But it is important to manage your risk, like I explained. So I like to have diversified portfolio to invest in things that I understand. So I've explained this. And it's important to diversify, because at the end of the day, some sectors, they can actually perform better during certain times. Like right now, the semiconductor sector is on fire, and the technology sector, but they're actually undervalued sectors. So that's something to have in mind there. Now, thank you so much for listening. If you like to touch base with me, you can touch base with me on Streetwise Economics, and also I have a YouTube channel where I share some of these insights. I'm gonna hand over to my colleague. Thank you. Thank you for tuning in to this podcast. Only 31% of the people who tune in to watch this podcast, they are subscribed. So I want to encourage you to please subscribe so that this content can reach far and wide. Thank you again, and may the markets be with you.
All right, I see a lot of questions in the chat. I'm going to start with the first ones. So if I can have Isaac and Blooming back, if you can both be on camera and be ready to unmute and take some questions. Thank you. I hope you guys are having a great time so far. So the first question, where does accountability go to when one loses value in Bitcoin? So Blooming, that question is for you.
Okay, so thank you for that question. I think what I'm going to say first, it's important to understand if you are a trader or an investor. If you're a trader, you care about the price today, tomorrow, next week, next month, 2 months from now. But if you are an investor, you don't care about the price because the price doesn't really truly reflect the value of an asset. Why? When you look at the historical track record of Bitcoin, those that just hold it for maybe a short time, majority of time they lose money. But for those that have been holding on to these 5, 7, 10, you see the massive wealth they are able to accumulate by just buying and holding. So in terms of accountability, you need to decide, are you a trader or an investor? If you're a trader, meaning that you care more about the short-term value or the price of the Bitcoin, then I'm going to tell you that you're truly, truly going to lose money. But if you're an investor, you don't care about what happens today. You don't care about what happened in the next 1 year or even 2 years. I tell most of my client or even my student, I'm an investor. I don't look at the price of an asset minimum 5 years. Minimum 5 years. Meaning that when I buy an asset today, I buy Bitcoin today, I buy Ethereum today, I don't care about the price. Why? If it dips, I'm excited. I'm like, yes, I want to buy more. Because why? I can accumulate more and just sit on it. The more I sit on Bitcoin over a long period of time, I'm telling you, you're going to be in massive wealth. So in terms of accountability, you need to decide you want to be a trader or just an investor. Personally, I will lean more towards the latter. So I hope that answered your question.
The market dropped, okay? Because you basically borrowing, in some cases they use margin and they do options. So what it means, you still have to pay the principal plus the money that you lost, plus interest. So at the end of the day, it's a very risky strategy, to use options if you don't know what you are doing. I put a caveat there. If you take time to educate yourself, that's why I created the course. You can consistently make money. However, trading, only less than 5% make money profitably. Okay, I tried it, but it's also emotionally draining. So that's why I'm kind of like a long-term investor. And I won't lie to you, it's very, very important to manage your risk because you can lose all or make a lot of money. Thanks.
Perfect. Yeah, I think he perfectly said it. I think really the best place for option trading, I was encouraged. This is no, I'm not promoting anything here, but simply just I think the best place for options trading is usually for corporations hedging against something big. I always encourage individuals. Options might not always be for you because, like you said, the volatility can be huge on that. But if you want to try it, go attend Isaac's course and learn before you get into it. That will be our advice. All right. Well, our suggestion, no advice, suggestions. Okay. That same person asked, well, another question, what's the difference between trading and investing? And I think, Isaac, you kind of had started on that towards the tail end of that. I don't know if we answered that question for you. Investing, you're going long-term and you're holding. Trading, it's kind of think of it as buying and selling. You're buying something to sell immediately. You're holding shorter positions, right, Isaac?
Yes, that's all right. Basically, traders, they just don't really care about the fundamentals. They can hold it like for seconds. Like when I trade options, I hold them for maybe 3 minutes, 3 seconds or 3 minutes. So sometimes, but it can be very stressful. Then swing trading, you are holding maybe for days or so. Usually I do so when stocks that I really understand, let's say when they drop, like what happened to Tesla, Nike, for example, right? CrowdStrike, if it drops to a certain level, but I usually have some understanding, then maybe I just buy 100 shares, I hold it for 2, 3 weeks. Usually I make a bit of money, but I'm not really worried about like the day-to-day fluctuation, right? I try to think long term because I will be focused on other things. But some people do day trade mostly, like just buying and selling. But it's very important to manage risk. I can't overstate that. I'll give you an example. Um, there was a day, I know at some point, usually when earnings are reported, nobody really knows. People can just react, sell off or buy. And what happens in the market, usually the way that I trade is like there's demand and supply. There are a lot of fund managers, like funds, like you're looking at big funds like Goldman and Sachs and stuff. Those can really move the market. So let's say they put an order block for 100 million at market price, then it can push the price up if it's a buy order. If they sell, then it can push the price down. So that's why I emphasize the risk, because regardless of whether you were right or correct, if there's a big order block that goes against your trade, and it's an option you are racing against time, you're done if you don't have a stop loss. So when you have a stop loss, then those are some strategies that I teach. You have kept risk, right? And you can also make kept profit, and you can also put a trading stock. There are different strategies. Again, it's very, very important to understand yourself. The biggest enemy in investing or trading is not understanding.
Yeah. And reading that question again, it maybe sounds to me the person used to work in the UK and has retirement assets in the UK and is looking for how to manage them, right? So John Isaac asked a good question. Do you want to continue to remain in the UK and leave those assets invested in the UK? Then you want to find out what assets would work for you. If you're now in Canada, do you want to move them over? There are rules around moving them over. To remain tax advantaged because they're retirement assets coming in. If that is what you're meaning, if it's retirement assets that are tax efficient, if you want to move them over to Canada, you also need to think tax efficient. So if you want to stay over there, then definitely you want to investigate what is happening there. Just a second side of the question, as I was reading, it just stuck to me that maybe you work there and had retirement assets there that you were looking for how to.
May I add something there? I think you bring in a good point. It's something that is not, talked about mostly the registered accounts here. So there are different accounts. So the best advice I would say, talk to a financial advisor or
Yeah.
a tax attorney or accountant, so that you avoid tax. You don't evade. You should pay what you're supposed to pay, but there's no reason to pay more than what you should pay to the government. Okay.
Yeah.
So that's another way of optimizing returns. A lot of
Yeah.
people, they save a lot of money by just understanding the tax code.
Yeah.
Thank
And UK and Canada have a tax agreement between them. There's also retirement agreements between them. So it's important to understand. Again, we go back to having a plan. Do you intend to remain in Canada, or would you like those assets to remain in the UK? So you do need to talk to an advisor to help you figure out what your long-term goals are. We hope we're answering the right question. We're going on a fly here. We hope we're answering the right question.
I think if I may add, I want to believe that this person is in the UK, and because some of our participants are also joining from the UK.
From the
So
UK.
this
Okay, makes sense.
person is, yeah. So for example, in the UK, the ISA account, the individual savings account, again, these are vehicles that you can use too. It's just like the TFSA in Canada. But again, these are individual questions that I would strongly recommend reach out to a professional that is well skilled in this, because again, we're not here to give any investment advice.
Yeah, perfect. Thank you. And she has said we have answered her question. All right, great job. All right, last one before we call it a night. Thank you everybody for waiting, and thank you for those who just joined us. The last question is investing in real estate or business a better decision than online trading? Who wants to jump on that one?
Okay, I can jump in first. I mean, investing is personal, but I would say, you know, some people can invest in real estate and make more money. So the key, like Coach Blooming always emphasizes, and you also have emphasized that, my dear colleague, that understand where you're investing. A lot of people can make money in the real estate because they understand how to value, you know, that. And trading, some people can, very few people though, make money trading, less than 5%. So if you are the top 5%, it might work for you. But I've said it in the presentation, there are various ways of investing in real estate. Through real estate trust, you can just buy shares. But more importantly, my colleague Blooming, we did a webinar where we ran numbers for people to say, if you are investing in the real estate or versus renting, right? Owning, run the numbers. A lot of time, a lot of people, they just jump into that without running the numbers. So it's on my YouTube if you missed that one, so you can consider doing that. So it's very important to run numbers or consult, you know, people like Blooming and myself to kind of like walk you through that, because a lot of the investing stuff, it's personal. It depends. Some people have a lot of debt, some people have this. So these nuances, when you then craft insights or recommendations, then it's based on those finer details. Thank you.
Yeah, thank you. I want to say thank you to all our speakers today, Isaac, Blooming, myself. I want to say thank you to the Finheads led by Mr. Well, put together by Mr. Femi Amodu. We sincerely appreciate you putting us all together. Thank you to everybody that came and joined us today, stayed and asked all the questions. If you would like to be a part of the Finheads, we're just a group of friends who come together, talk about investing, talk about financing, and talk about any other financial kind of question going on. And we host this event regularly. Please put your details in the private chatters, either myself or Dr. Femi Amodu private chatters. I will get you into the group for more sessions like this that we host. Again, wherever in the world you are joining us from, UK, Canada, US, Nigeria, we want to say thank you. Have a beautiful night. We will see you at our next edition.